Well, welcome to Beers with Rich. I'm Rich. It's great to be back with the birds, editor of Under the Radar Report. This week's episode is brought to you by, here we go, for some, this could be the highlight, this little pale ale, Mismatch Brewing Company. Their pale ale, actually it's just called pale ale, Mismatch. The label is what caught my eye. Let's just get ripped right straight into it. A toast to small caps. It's pretty good. It's pretty good. Let's just see how it goes. A good start. Well, I've got to hold on to my beer because, I've got to tell you, there's no doubt about it. Once bitten, twice shy. Well, I just love small caps for one reason. And that one reason is one word: growth. Look, what impressed me from the get-go, all those years ago, was how much difference it made to my portfolio. Basically, I realized soon after I started that the more I owned, the more chances I had. The more I had on the table, the more potential. Because I knew it was only a matter of time before they did what this beer just did: explode. And I'm talking about some pretty big explosions. Whether it was a gold miner, I remember, or a silver miner, or I think the first one that ever exploded was actually a blood bank. Mind you, it came back pretty quickly too. But anyway, here's to those past successes, and to future successes, and to current successes, which I've got to mention. Well, two stocks, both come from the idle speculator, our portfolio's first love, media. That man loves media. Here's to regional TV owner Prime Media, up 70% after a takeover bid by Seven West. And the weirdly named radio group Here, There and Everywhere, up 30%. Well, more on them later, but let's just have another sip. But, growth is important, but over time I realized when the market sells off, the key to the protection of my portfolio was dividends. Then, it came to me, a realization, like Paul from Damascus. I realized I could get the best of both worlds, growth and income. So basically the best, one of our earliest wins here at Under the Radar Report, I think it was we picked it in 2012, was Certex Medical. That ended up climbing something like 7 or 8 times. And not only was I impressed by their technology, their liver cancer treatment, which was approved. It was a medtech approval. But I was also impressed by the fact that they were paying dividends early on. So this really was a good, as they say, a virtue signal. So a lot of companies, in my experience, they say, "Oh no, dividends. We're not paying dividends. We're all about growth." But just as the idle speculator says, the dividend is the one difference between speculation and investing. And in my opinion, investing is much more profitable with less risk. So as we say, it's a no-brainer, or as I say, it's a no-brainer. So what do we look for? What do we look for in these dividend-paying stocks? Well, basically cash flow. Cash flow is key. So you're looking for operating cash flow to, cover the dividends. You're looking at their assets and liabilities. So what's their current ratio? How much, current assets do they have to cover their current liabilities? But mostly you're looking at the term of their liabilities. So versus the term of their assets. So have they got long-term income streams that can pay out sort of their long-term liabilities? When there's a mismatch, that can be dangerous. But then there's also the growth potential, which comes from being in the small cap world. So dividends were rewarded here in Australia, as you'd all probably know, because of franking credits. They're basically giving credit to people because of domestic profits. But the key word here is profits. You can't pay dividends if you don't make profits. That in itself is an important factor. And it's a key element to fundamental analysis, which is what we embrace it Under the Radar. So, and because we've embraced it, we've actually had quite a bit of success with our dividend portfolios in the past 5 years that we've been doing them. So we've done 10 portfolios that have returned an average of 17%. Like the benchmark return is like half this sort of amount. You know, whether you're looking at the small ordinaries, which is slightly better than the all ordinaries. But the fact is that good stock picking does deliver the goods, and good stock picking involves looking for companies that can pay dividends. So the thing that I'd like to talk about quickly is that, you know, basically that diversification element, but encapsulated in the three stocks that we've covered recently. BizAlloy, Gale Pacific, Capral, all up 75%. And that's the thing with all these dividend portfolios with diversification, we've got one or two that have been big winners. So that's more than offset the losers. So getting back to what I was talking about before, the three companies, well, I've mentioned Prime Media and Here, There and Everywhere, but there's been disappointment, on the other hand, with workplace technology group Damstra. So I'd say that all these stocks have great foundations, and I'd like to just go through them quickly. Prime, we love its cash generation because media's been disrupted, but what this company was generating was heaps of cash, which was repairing its balance sheet, and then it was paying dividends. Obviously, COVID, you know, was an upsetting event for it, but the bounce back was unbelievable. I mean, this company paid a 2-cent dividend on 23-cent share price. So think about the yield on that. So basically, that's what Seven West want. They want good cash flow. That's what we want. So that's why you're seeing Seven West Media paying up for, you know, paying a 70% premium when the normal premium is like 30%. But moving on, I think probably Here, There and Everywhere for, you know, is more interesting because this is where I think there's future promise. Basically, this company had this 200 million tax Damocles sword in the form of an ATO tax liability hanging over its head. Then last week they settled for 71 million. So the stock rallied 30%, but we think it's going to keep rallying. Why do we think that? Because the stock's PE's multiple can get re-rated as investors warm to the growth story that this radio-owning media company has. So there's a big factor in the elimination of uncertainty here. So it's certainly one we like. Damstra, on the other hand, you know, with its workplace technology, I've mentioned in the past on beers, it does have it certainly seems to have big potential, but it's in the balance. And what happened was Newcrest, the activity that Newcrest of one client was lower than the market expected. So that really hit their sales line, having achieved really, really impressive sales growth. So some of these little companies are vulnerable to the bumps in the road, and you have to be a bit cautious, which is why we've pulled back our recommendation. So, you know, what I'm saying is the more irons in the fire you have, the better, and the more researched irons in the fire, the better. So what have we got next week? Well, before I go to next week, I'm going to have another the mismatch pale ale. Quite a nice little number actually. It grows on you like most beers. The more you drink, the better you feel. But it's got a bit of a COP26 feel to it, the next issue, which is really exciting because we're actually also delving deep into uranium and nuclear. And this next week, we're looking heavily at the nuclear sector, where we're making some big returns from the likes of Paladin, Boss Energy, Bannerman Resources. So there's a lot of excitement in that sector, and we're going to be covering that space. Plus, there's always a plus, we're doing the dividend portfolio, the current dividend portfolio. So a lot to look forward to. Here's to you. Great that we're all, you know, out of the lockdown. Happy days.